A very good afternoon, all of you. Hope you all are doing good. May God bless you all. Welcome to Commerce second year classes. In the last two classes, we have done problems on retirement of a partner, which is expected for 20 marks. Okay. So we were doing problems on retirement of a partner. And we did few problems also. Today also, we'll be doing problems on retirement of a partner, but where a different treatment of goodwill is taken. Okay. Like last 2 days, we were doing problems where goodwill was raised. That was the method we were doing problems based on. This method we were doing problems. Today, we'll take the next method. What is it? Goodwill raised. Like if goodwill is raised, you have seen goodwill amount will appear in the balance sheet. What if we do not want to show it in the balance sheet? Then what do? Is we simply write off the goodwill. So it will not appear in the balance sheet. So this method, we will learn the accounting treatment and as well as we'll do few problems on this method. What is the method we are learning? We are learning the method where goodwill is raised and written off. So for raising the goodwill, we'll pass this simple entry. Goodwill account debit. Goodwill account debit to, let us say our partners are X, Y, Z. We will pass this entry. Goodwill account debit to all partners account in the old profit sharing ratio. We pass this entry. And like, let us say if Y is retiring, then to write off the goodwill, we will debit the continuing partners. X account debit, Z account debit to goodwill account. Right? And this will be done in new profit sharing ratio. This will be done in new profit sharing ratio. And if you see here goodwill account is debited, goodwill account is credited. So as such, the goodwill account will get closed. There won't be any balance in goodwill account. As such, it will not appear in the balance sheet. If it is only raised, goodwill was showing debit balance. So we were showing goodwill amount in the balance sheet. Now here, goodwill is debited and goodwill is credited. Goodwill account gets closed. As such, it will not appear in the balance sheet. We are doing problems based on this treatment of goodwill today. Okay. Is it okay? So we'll take one question from the textbook. I'll first explain you the treatment of goodwill. Then we'll take up the question. Okay. Now see page number 304. Page number 304 and question number is 9. So we are only doing treatment of goodwill here. Then we'll take up the question. Dravid, Ganguly and Sachin are sharing profit and losses equally. How many partners? Dravid, Ganguly and Saurabh. Profit sharing ratio is 1:1:1. Dravid, Ganguly, Sachin. Sorry, it is Sachin. 1:1:1. Okay. And the value of goodwill is given as 45,000. It is raised and written off. What is the value of goodwill given? Goodwill is raised at 45,000 and it is immediately written off also. And the new profit sharing ratio is given as 3:2. This is OPSR and NPSR. Who is retiring? Dravid is retiring. Dravid is retiring. So Ganguly and Sachin will continue in the ratio 3:2. See now, this is the old profit sharing ratio 1:1:1. That is 1/3, 1/3, and 1/3 we can say. And Dravid is retiring, and the continuing partners. Who are the continuing partners? Ganguly and Sachin. Ganguly and Sachin are sharing the new profit, the profit in this ratio. This is the NPSR. So, and it is said that goodwill is valued at 45,000, raised and written off. So let us see the first step. When goodwill is raised, the entry would be goodwill account debit. Goodwill account debit 45,000 to Dravid, Ganguly and Sachin. Dravid, Ganguly and Sachin. What is the ratio? Equal ratio. That is 1/3, 1/3, 1/3. So each one will get 15,000 credited. 15,000, 15,000. This is the entry we passed for raising the goodwill, being goodwill raised. This is for the goodwill raised. In what ratio? If you can see, it is in OPSR. And then I told you it has to be written off in new profit sharing ratio, in the new profit sharing ratio to the continuing partners. If Dravid is going away, who are the partners continuing? Ganguly and Sachin. So the next entry would be Ganguly account debit. Ganguly account debit. Sachin account debit to goodwill account. Total of goodwill is 45,000. Okay. Total of goodwill is 45,000. And that is debited to continuing partners in new ratio. What is the new ratio? The new ratio is 3:2. So this 45,000 is to be debited in the ratio 3:2, that is 3/5 and 2/5. 5 nines are, so it is 27,000. 5 nines are, it is 18,000. So Ganguly is debited with 27,000 and Sachin has to be debited with 18,000. See the treatment, accounting treatment, goodwill account debit to all partners in OPSR and continuing partners to goodwill account in NPSR, new profit sharing ratio. Goodwill is debited with 45, it is credited with 45. Goodwill account will get closed, no balance left. So we have raised it and we also have written it off. Okay. So now let us take the question. So Dravid, Ganguly, Sachin are partners sharing profit and losses equally. Their balance sheet is given and additional information is given where it is said that fixed assets are revalued at 80. In the balance sheet, fixed assets are given as 71. Now 80. So there is an increase of 9,000. Provision for bad debt 6%. Debtors are 45. Okay. So only two adjustments. A very small revaluation account we have to prepare. Revaluation account. Particulars amount, particulars amount. So fixed assets valued at 80. Earlier they were 71. Now they are 80. So there is a hike. There is an increase of 9,000 in the value of fixed assets. It is again credited to revaluation account. Provision for bad debt is 6% on debtors. Debtors are 45,000. What is the value of debtors given? Debtors are 45,000 into 6/100. 2,700. To provision for bad debt 2,700. So what is the revaluation profit we got? It is 6,300. This is revaluation profit. And this revaluation profit is to be distributed between Ganguly, it is to be distributed between Dravid, Ganguly, Sachin equally. 2,100, 2,100 and 2,001. Is it okay? Yeah, so simple. Then we prepare cash account. If there is any effect, if there is any treatment where cash is affected, no, there is no effect on the cash or bank balance. So let us not prepare cash book, cash account or bank account. Let us directly prepare goodwill account. Okay. What are we preparing? We are preparing goodwill account, and this is the method where goodwill is raised and written off. Goodwill is raised and written off. We did the accounting treatment in the last slide. particulars amount, particulars amount. When goodwill is raised, it is debited to goodwill account as to Dravid, to Ganguly, to Sachin. What is the value of goodwill raised? 45,000. Distributed equally. So 15, 15 and 15. This is for goodwill raised. This is the posting or this is the treatment for goodwill raised. Now that we are writing it off, now that we are writing off the goodwill, so the partners, the continuing partners, the partners who are continuing the business after the retirement of Dravid, they are to be debited and goodwill is to be credited. So for that, I will write by Ganguly 27,000, by Sachin 18,000. This is how goodwill account is closed. Goodwill account is closed. So goodwill amount will not appear in the balance sheet. Goodwill account will not appear in the balance sheet because we have written off the goodwill amount. Clear? Now let us take partners capital account. Let us prepare partners capital account. Okay. Dravid, Ganguly, Sachin, Dravid, Ganguly, Sachin. Okay. Partners capital account. Debit, credit. Usually, we get 4 items on the credit side of partners capital account. What are those? Capital, goodwill, accumulated profits, revaluation profits. So let us see if we have all those. Yeah. By balance brought down. This is for the opening capitals. The capitals of Dravid Ganguly 60, 40, 30. 60,000, 40,000, 30,000. Then goodwill is raised. For that we will write by goodwill credited to all the partners. Credited to all the partners. And it is written off. Written off to continuing partners. Written off to continuing partners. Who are the continuing partners? Dravid retired. Ganguly and Sachin are the continuing partners. Then accumulated profits. General reserve is given. Why? General reserve is given as 24,000. That 24,000 is to be distributed in old profit sharing ratio, which is equal. They were sharing profit and losses equally. So each one will get 8,000, 8,000, 8,000. 8 3s are 24. Then revaluation profit. We prepared revaluation account, no? And we got a profit of 6,300, which was distributed equally to 3 of them, which comes to 2,100 and 2,100, 2,100. Now let us close this. 60 plus 15, 75, 75 plus 8, 83, 85,100 is the total on the credit side. See once again, 65, 75, 83, 85, 100, 85, 100. I always tell, no, whoever is retiring, you first close his account. Who is retiring? Dravid. So now Dravid is to be paid how much? 85,100. The firm has to pay 85,100 to Dravid. Let us see if he is paid anything. No, he is not paid anything. Then what do? The entire amount we will transfer from his capital account to his loan account. From his capital account to his loan account. And for the rest of the partners, since they are continuing to be the partners, that amount stands in their capital account only. 40 plus 15. 55 plus 8, 63, 65,100. So what is the capital? Sorry. What is the capital of Ganguly to balance carried down? 65,100 and Sachin 53,100. 53,000. No. We have a debit balance, no? So what is the total of Ganguly on the credit side? 65,100. Ganguly total on the debit side is, the credit side is 65,100 and debit side we have debited him with 27,000. So we have to do balancing 65,100 minus 27. How much? 38,100 would be his capital. 38,100 would be Ganguly's capital in the new firm. And then similarly, Sachin's credit was 53,100 and debit we have 18,000. So deduct, it is 35,000, 45, 8, 53, 55. 55,100 minus 18,000. It is 37,100. Okay. So this is how this would be 65,100 and 55,100. 65,100 and 55,100. Go through. Here the total was 55, not 53. What was the total? Was 55,100. So from 55,100 deduct 18,000, that would come to 37,100. So these are the opening capital balances of continuing partners. By balance brought down, 38,000 Ganguly and 37,100 Sachin. Right? Done. Now let us go to balance sheet. Let us go to balance sheet. Balance sheet of the new firm after the retirement. Balance sheet of the new firm as on. Balance sheet of the new firm as on 31st March 2020. Draft the balance sheet in the same sequence as given in the question. What is the first item we have on the asset side? Asset side, the first item is cash at bank. Cash at bank. And there is no change in the balance. So write as it is. Cash at bank is given as 32,000. Then bills receivable, there is no change. Bills receivable, there is no change. Right as it is, 18,000. Okay. Debtors. Debtors are given as 45,000 and we have created a provision. If you refer revaluation account, you can see we had created a provision of 6%. Okay, 6% provision on debtors, which was 2,300. 2,300. 700, sorry. 6 5 are 0, 3, 6 4 are 24, 24, 27. So 42,300 is the net balance. Then we have stock. We have stock. Okay, stock in the book value, it is 50,000 and there is no change. There is no change. So let us take stock as it is, 50,000. And lastly, we have fixed assets appearing in the balance sheet as 71,000, but they were appreciated by 9,000. So now the value we'll take is 9,000. So 80,000 is the current value. Okay. And if you remember, in the last problems, what we were doing in the last 2 days, where goodwill was valued, I was taking it on the asset side. I was showing goodwill here on the asset side. But here, we will not show. Why? Because the goodwill is written off. Written off means there is no balance left in the goodwill account. As such, it will not appear in the balance sheet. On the liability side, we have bank overdraft. We have bank overdraft. Bank overdraft is given as 18,000. Then outstanding expenses. Outstanding expenses as it is. Then creditors, 28,000. Creditors, 28,000. Then general reserve, do we take? No, it is credited to all the partners. Now let us take capital accounts. Capital accounts will show only for the continuing partners, that is Ganguly and Sachin. Ganguly and Sachin. And Dravid is retiring, that we have transferred his amount to Dravid's loan account. Isn't it? Refer the partners capital account. Dravid loan account is 85,100. And the rest of the partners, it is 38,100, 37,100. Okay. So Dravid's loan account is 85,100 and this is 38,100, 37,100. Let us check the total. Total on both the asset side and liability side. Okay, so do the sum up. What is the total you see? 50, 92, 140, 2,22,300. 18, 34, 54, 6, 54, 62, 142, 147, 147, 300, 185. Yeah, 2,22,300, 2,22,300 on both the sides, assets and liabilities. Okay, is it okay? We are doing retirement of problem where we are doing treatment of goodwill. Goodwill is raised and written off. When goodwill is written off, it will not appear in the balance sheet. We are doing that method. So, hope this is clear with you all. Okay. We take the next question, that is question number 10. P, Q and R are sharing profit and losses in the ratio 2:1:1. Their balance sheet is given. On the above date, Mr. R decides to retire from the business. Goodwill of the firm is valued at 20,000 and written off completely after the retirement of R. Then remaining stock to be depreciated, 5%, building, amount payable to R is transferred to his loan account carrying 6% interest per annum. Okay, we don't have to show any effect for this interest, 6% interest in our till balance sheet. That is the further proceedings. Those are the 6% interest payable to him is the further proceeding that will fall in the academic year after, sorry, in the financial year after the retirement of the partner. So we don't have to give any effect to the rate of interest or how the interest is paid and all that. We don't give any effect to that. It is immaterial for us. Simply ignore that. Okay. Anyhow, even if he doesn't say, what are we doing? We are transferring the amount payable to retiring partner to his loan account only. If it is paid, well and good. Otherwise, what we will be doing? We were transferring the amount to his loan account. And in this question, it is said that he is paid interest of 6%. That will have no effect in our balance sheet. Those are the further things after the retirement in the books of account. Those will appear subsequent to his retirement. So we don't have to give any effect. Okay. So please don't get confused with that 6% interest kya hai, wo sab kya hai. All these things are immaterial for us. Shall we take up the question? Yeah. P, Q, and R are partners sharing profit and losses in the ratio 2:1:1. This is the OPSR. So what we'll do is again, first we will do the accounting treatment for goodwill. Goodwill raised and written off. We'll do the accounting treatment of goodwill. Then we'll move to the question. So who are the partners? P, Q, R. What is the profit sharing ratio? 2:1:1. This is the old profit sharing ratio. And what is the goodwill amount? Goodwill is raised at 20,000. Goodwill is raised at rupees 20,000. And who is retiring? R is retiring. R is retiring. P and Q are going to continue the firm in the ratio 3:2. So this is the NPSR. So old profit sharing ratio is given, goodwill is raised and written off. See what is the accounting treatment. For raising the goodwill, we'll write goodwill account debit 20,000 to P, to Q, to R. To P, to Q, to R. 20,000 in the ratio 2:1:1. Old profit sharing ratio, that is 2/4. Okay, P will get 20,000 into 2/4. 20,000 into 1/4. That is 5,000. And another 5,000. Okay, so how will it appear? 10,000, 5,000, 5,000. Being goodwill raised. So as per the entry, partners will be credited. P will be credited with 10,000, Q 5,000, R 5,000. This is for raising the goodwill. What is the second step? For goodwill written off. For goodwill written off, it is written off only to the continuing partners. That is P account debit, Q account debit to goodwill account. P account debit, Q account debit to goodwill account. What is the total amount of goodwill? Yes, it is 20,000. It is to be written off in what ratio? 3:2. That is 3/5. So P will get 20,000 into 3/5. 5/4 are 12,000 debited to P, 8,000 debited to Q. Goodwill is debited with 20. Goodwill is credited with 20. Goodwill account gets closed. As such, will not appear in the balance sheet. Okay. So this is the goodwill treatment. Have a look at once. Now let us prepare revaluation account. Stock is to be depreciated by 5%, furniture 10%, building is valued at 43,000. Okay, so we have only three adjustments in revaluation account. Particulars amount, particulars amount. Stock is depreciated by 5%. Stock is given as 30,000. 5% of that would be 1,500. To stock 1,500. Then furniture is depreciated by 10%. Furniture is given as 3,000, 35,000. It would be 3,500. Building is valued at 43. In the balance sheet, it is given as 34. Now it is valued at 43. There is an increase of 7,000. Okay, so close this. We have incurred a profit of 2,000 on revaluation. Okay, how much? Sorry. Stock is depreciated by 5%, 1,500. Furniture is depreciated by 10%, 3,500. Building is valued at 43. So it is 9,000. 34 plus 9 is 43. So 9,000. So now this would be how much? 4,000. Revaluation profit is how much? 4,000. And this revaluation profit is credited to PQR in what ratio? What is their old ratio given? 2:1:1. 2:1:1. That is 2/4, 3/4, and 1/4. So P will get 2,000, 1,000, and 1,000. Okay, P will get 2,000, R will get 1,000, and Q also will get 1,000. Clear? Okay. Then we'll prepare. Okay, we'll not prepare cash account. There is no effect. So we'll directly take up goodwill account. Particulars amount. Particulars amount. But for raising goodwill, goodwill account debit to all partners, to PQR. To PQR. It is, we did know. Here we have done. Partners are credited with 10,000, 5,000, 5,000. 10,000, 5,000, 5,000. And only continuing partners is P and Q are debited. Debited with how much? 12,000 and 8,000. Pay attention on this. For raising goodwill, we have debited goodwill account to all partners. For writing it off, we have credited goodwill and debited partners, continuing partners, the partners who are continuing the firm, continuing the business after the retirement of R. So then we have debited. So here goodwill account gets closed. Goodwill account gets closed. So will not appear in the balance sheet. Okay. So what is the next step? Yes, it is preparation of partners capital account. So we'll prepare partners capital account now. Who are the partners? PQR. Ready? P Q R. P Q R. We credit partners with 4 items. What are the 4 items? One is capital. The other one is goodwill. Then accumulated profits. Then revaluation profit. So what are the capitals given? 40, 20, 20. So let us take the capitals as buying, balance, brought down. P's capital is 40, Q's capital is 20, and R capital is also 20. 40, 20, 20. The second thing is goodwill. Buy goodwill. What was the amount of goodwill we have credited each partner? No? 10,000, 5,000, 5,000. This we have credited them. This we have credited them for goodwill raised. This we did as for goodwill raised. Now we have written off. We have written off. So when we write the goodwill off, when we write off the goodwill, it is debited only to continuing partners, which we did. P is debited with 12 and Q with 8,000. Have a look at this. Return on the credit side is for raising. Return on the debit side is for writing off the goodwill. Okay. Then what is the next item? It is general reserve we have in the balance sheet. No general reserve is given. Okay. General reserve or any other accumulated profit is not given. So let us not think. Then we have revaluation profit. We got a profit of 4,000. Remember, we got a revaluation of 4,000 and that was distributed as 2,000, 1,000, 1,000. So that we have to credit to old partners. 2,000, 1,000 and 1,000. Okay. Now let us balance the ledger accounts. Let us balance the ledger account, see what is the net result. That would be the closing capital or the opening capital of the new firm for continuing partners, and for outgoing partner, we will transfer the amount to his loan account. And again, I repeat, it is said here, the amount payable to R is transferred to his loan account carrying 6% per annum. This will have no effect in our balance sheet. The interest rate or how the interest is paid will not have any effect in our balance sheet. Those are the things to be considered subsequently after the retirement. So who is retiring? R. Let us close his account first. 26,000. Okay, so this will be transferred to R's loan account. 26,000. How much? It is 26,000. R's loan account is 26,000. Then T's account 40, 50, 52,000. 52,000 minus 12 minus this 12, 40,000. This is the closing capital. For Q, 25, 26,000, 26,000 minus 8, 18,000. Okay, so here it is 26. By balance brought down. Now, P's capital would be 40 and Q's capital would be 80. Clear? So that's good. Now let us prepare the balance sheet. That is the last step. We prepare the balance sheet. Balance sheet of the new firm. Balance sheet of the New firm as on. When was the retirement done? It's 31st March 2020. 31st March 2020. What it should be? Liabilities, no? Okay. Prepare it in the same sequence as given in the balance sheet. In the same sequence as given in the balance sheet. What is the first item given in balance sheet? It is cash. Cash is 3,000. Right as it is cash 3,000. Okay. Cash 3,000. Then debtors. Debtors are 18,000 and there is no change, no provision. So let us write debtors 18,000 as it is. Then stock. Stock is depreciated by 5%. The value given in the balance sheet is 30 and it is depreciated by 5%, which amounts to 1,500. Deduct and take 28,500. Investments, there is no change. There is no change. So write investments as it is. That is 20,000. Write as it is. Then furniture. Furniture. Furniture is given as 35,000. Furniture is given as 35,000. Depreciate. Depreciate. Depreciate furniture by 10%. 3,500. Take 31,500. Okay. Next, buildings. Buildings are 34. Buildings are 34, but now they are revalued at 43. So 34,000. Add appreciation 9,000, 43,000. Do we take goodwill? No, we will not take goodwill. We will not take goodwill because goodwill is written off. Okay. Then let us go to the liability side. Capitals are given. Capitals will take only for P and Q, the one who are continuing. And their capitals we have found out to be 40,000 and 18,000. Then R is retiring. The amount payable to him. What was the amount payable to him? It was 26,000. We have transferred to his loan account, 26,000. Then we have creditors 36. 36,000. And then bank overdraft 24. Bank overdraft 24. So now see the total. What is the total of balance sheet? 58, 78, 84, 90, 151 lakh, 74,000. 59, 60, 80, 80, 80, and 7, 155, 1 lakh, 74. Okay. It is, sorry. 1 lakh 44,000 we are getting. Yeah, 1 lakh 44. Here, 40, 58, 58, 64, 84, 90. This amount, 56,000, 40, 40, 18, 26. Then this is 36, 60, 86, 96, 104, 142. Yeah, 1 lakh 44,000 on both the sides. 1,44,000 on both the sides. Okay, so done. So this is how we have done our second problem. Then there is one last problem based on this method, and then we have to take up the next topic, that is consignment. So we'll do the last problem on this method, that is question number 11. Raju, Rani and Prince are partners sharing profit and losses in their capital ratio. In their capital ratio. See, profit sharing ratio is not given here. Profit sharing ratio is not given, and it is said that profit sharing ratio is capital ratio in the capital that stood as on the balance sheet date. So what are the capitals of Raju, Rani and Prince? Raju, Rani and Prince. Their capitals are 50,000, 30,000 and 20,000. 50,000, 30,000 and 20,000. That is 5:3:2. Okay, 5:3:2. So we have to take this as the profit sharing ratio. Okay, profit sharing ratio stood in their capital stood as on the date of balance sheet, means whatever ratio their capitals are bearing in the balance sheet, that should be taken as the profit sharing ratio, which stands to be 5:3:2. Okay, done. What else? Then we have general reserve, we have P&L balance, both are accumulated profits, which we have to credit to old partners in old profit sharing ratio. Rani is to retire from the firm, goodwill is valued and written off. Okay, so we'll start with revaluation account. As usual, we'll take up the revaluation account first. Revaluation account. Okay. Value of the building is appreciated by 10,000. So we'll take 10,000 on the credit side. Then depreciate machinery by 5,000. Directly give the amounts. So we can directly take the amounts as machinery is depreciated by 5,000. Stock is depreciated by 2,000. So we'll take directly 2,000. Goodwill of the firm is valued. Okay, here the revaluation account ends. 10,000, 10,000, 5 to 7. So 3,000 is the revaluation profit. It is the revaluation profit which is to be credited to Raju, Rani and Prince. In what ratio? Remember, I have just shown, no, 5:3:2. 5:3:2. This 3,000 is to be distributed in the ratio 5/10, 3/10 and 2/10. Okay, Raju, Rani and Prince. So how much will Raju get? He'll get 1,500. Rani will get 900 and Prince will get 600. Okay. Then the goodwill account. Sorry. The goodwill account. Goodwill is raised and written off. Raised in old profit sharing ratio, credited to all partners, written off in new profit sharing ratio, debited to continuing partners. So When we raise the goodwill account, we have to debit it to all the partners, Raju, Rani, and Prince. To Raju, to Rani, and Prince. What is the goodwill amount given? Goodwill of the firm is valued at 10,000. So 10,000 again in the ratio 5:3:2. 5 by 10. 5 by 10,000 into 5 by 10. So he will be credited with 5,000. 3 by 10, 3,000. 2 by 10, 2,000. Right? Now to write off. Who is retiring? Rani is retiring. Okay. Who is retiring? Rani is retiring. And the new profit sharing ratio would be 3:2 it is given. What is the new profit sharing ratio? It is 3:2. Okay. So now by Raju and by Prince, this 10,000 is to be debited to Raju and Prince in the ratio 3:2. 3:2. Okay. So how much it will be? 10,000 into 3 by 5. I think 6,004. So goodwill account is closed. How did we get 6 and this? 10,000 into 3 by 5. 10,000 into 2 by 5. Okay. Then let us take partners capital account. Partners capital account. Okay. So partners capital account. Who are the partners? Raju, Rani, and Prince. Rani is retiring. Okay. Rani is retiring. Let us credit everything that she deserves or what she is supposed to be credited with. Whatever the firm owes to Rani, will credit with that amount. So by balance brought down. Their capitals are 50, 30, 20. 50, 30, 20. Then take the goodwill credited to them. The goodwill was 10,000 and the amount credited was 5, 3, and 2. Immediately, goodwill is written off also. Written off to whom? Written off to continuing partners. That was 6,000 and 4,000. Then accumulated profits. General reserve is given as 10,000. General reserve is given as 10,000. 5:3:2. So again, 5,000, 3,000, 2,000. P&L credit balance is given. Even that is distributed in old profit sharing ratio. 5,000 is the amount. So 2,500. 5:3:2. So 5,000 into 3 by 2. 5,000 into 3:2. 5 by 10. 5,000 into 3 by 10. 5,000 into 2 by 10. So Rani will get 15 and Prince will get 1,000. Then the last item, that is revaluation profit. Revaluation profit we have calculated, no? 3,000 was the profit. And what was the amount? We have credited each one 1,500, 900, 600. So 1,500, 900, 600. Now balance. First, let us close the outgoing partners account. Who is it? Rani. 36, 37, 38,400. This we will transfer to her loan account, to Rani's loan account, 38,400. Then Raju, 55, 60, 64,000 on the credit side. 64 minus 6,000. It will be 58,000 to balance carried down. What is Raju's capital in the firm? New firm? 58,000. Okay. Then Prince. 25,600 minus 4. It is 21,600. By balance brought down. Raju's capital is 58 and Prince capital is 21,600. Okay, so with this new balance of capitals, we will prepare the balance sheet. Okay, so now let us prepare the last item, the last thing, in retirement of partner, that is the balance sheet. Balance sheet of the new firm as on 31st March 20. Assets, liabilities. See the sequence on the asset side. We have buildings. Buildings are given as appreciated by 10,000. So now there will be 35. In the balance sheet, it is 25 plus appreciated by 10,000. So 35. Machinery, 55 was the book value. Machinery, 55 was the book value. It is depreciated by 5,000 to take 50,000. Then investments. $10,000. 20,000. Sorry. Investments are 20. Stock is given as 30 and it is revalued by 2,000. So we have 28,000. Debtors, there is no change. Let us take as it is 20,000. And then bank balance, we have 10,000. On the liability side, we have capitals. Raju, Prince. Rani has retired, so her amount was transferred to her loan account. What is the capital of Raju? Capital of Raju is 58. Capital of Raju is 58. Capital of Prince is 21,600. And the loan payable to Rani is 38,400. Then general reserve is distributed. P&L is distributed. The next liability is loan from bank. How much it is? 25,000. And lastly, we have creditors. Creditors are given as 20. Let us see the sum up, the total of balance sheet. How much it is? 1. So 80, 110, 119, 159, 159. It is 163. 1,63,000 on the liability side. Okay. Asset side 35, 85, 105, 105, 125, 133, 153, 1,63,000. Okay, 1,63,000 and 1,63,000 here also. 58, 79, 80, 80, 118, 138, 160. Yeah, it is done. Okay. So, okay, guys, we are done for the day. I'm ending the session here. Tomorrow we'll start a new topic, that is consignment. Okay. So good day. Take care.